What's good, everybody? Today is July 23rd. It's 1:49 p.m. Today, we are going to be learning about liquidity sweeps in today's episode of the Beginner's Blueprint to Success. I believe today is day 11, 12, maybe day 13. I don't know. I'm pretty fucked up on my days. But yeah, today we're going to be learning about liquidity sweeps. A few videos ago, we learned about what liquidity is, right? Where it lies, right? What does it lie? Above highs, below lows. And essentially what it is, right? Resting orders, etc. Well, today we are going to be learning about liquidity sweeps. Now, liquidity sweeps are very important. It's a pretty easy concept to grasp. However, there's a lot of knowledge to it. But it's very important because it determines where price wants to go for that day, right? So I use this concept almost every single time when I get into a trade, right? I'm first thing I'm looking for is a liquidity sweep, and then I'm looking for like conditions after liquidity sweep. And again, we'll get into conditions later on. But moral of the story is it's very important, and I use it almost for every single trade, and not like almost like I would say like about 97% of the time I use it to get into trades. So we understand that it's important. So without further ado, let's get right into it. I'm just yapping about nonsense. And I got the shades on today. That means you know it's a great day. Just won the trade I took. So without further ado, let's get into liquidity sweeps. Let me get my fat ass head out the way. So again, brief review. What is liquidity? Well, it's pending / resting orders in the market looking to get filled. What does that consist of? Well, stop loss areas, take profit areas, and when people have limit orders, which means essentially they will just right click, put right here, buy NQ at 23.056. So as soon as NQ hits the 23.056 mark, which is this area, it'll throw me into a trade, right? That's what a limit order is. Now, moving on to what is a liquidity sweep, it's when we go and sweep past those areas, filling those resting orders, right? So price can then reverse and go where it wants to go for the rest of the day. That's all a liquidity sweep is. Now, liquidity sweeps are happening on every single time frame at every single second. However, we're only worried about specific liquidity sweeps, and we'll get into that later on, right? You might be asking yourself, well, why do we have to fill orders in order for someone to either buy or sell? Well, say big money comes in, right? Each session, new big money comes in. The market makers come in, new market makers come in, etc. And say they have 1 million shares of sell orders. Well, what does that mean? That means we're going to have to go sweep buy side liquidity, right? Because if he wants to sell 1,000 shares of NASDAQ or whatever the fuck it is, shares, I don't know how that works. I really just day trade. I don't know how the actual market works. Not the point. If he needs to sell 1 million shares, well, someone is going to have to buy those 1 million shares, right? So what does that mean? We're going to have to go up, sweep out buy side liquidity, fill those orders. So if he wants to sell and short the market, there's enough people to buy in order for him to sell. Does that make sense? And again, it's the same thing going the other way, right? If we are buying, or big money come, not we, because we're not going to be buying 1 million shares, but if the market makers come in the New York AM and want to buy 1 million shares of NASDAQ, what do we have to do? Well, there has to be 1 million people in order to sell those shares. So what do we have to do? We have to go seek out the sell side liquidity, fill all those resting orders, so then we can then reverse price to the upside. So with that being said, I made a little Picasso drawing down here. Let's go down and look at it, right? So say this dotted line represents New York market open, right? And each session, we'll get into sessions later on in this video, but each session there's new market makers coming in and trying to move the market where they want to go, right? So say we're in an uptrend and he wants to long 1 million shares of NASDAQ, right? So what does that mean? If he wants to buy 1 million shares of NASDAQ, there has to be 1 million shares of sell orders that people are willing to sell him, right? So what does that mean? That means when the market opens, we're going to have to manipulate lower and fill orders. So what do we have here, right? We have resting liquidity right here. We have resting liquidity right here. We have resting liquidity right here. And we have resting liquidity right here, all on the sell side, right? The buy side will be on the top of the market. The sell side will be on the bottom. So if he wants to long 1 million shares, what are we most likely going to do first? Well, we're most likely going to open up, manipulate lower, stopping all those people out who think we're going long right now, right? On top of that, either stopping these people out or filling their orders, one or the other. So we can then, or he can then reverse the market and go where he wants it to go for the rest of the day, right? That's all a liquidity sweep is, right? So we have the trend line liquidity right here. We come down, fill all these orders, so then he can then long the market and move price where he wants to go for the rest of the day and continue the uptrend to the upside. Now, liquidity sweeps can become a little confusing because we never know exactly what sweep of liquidity will reverse the market. But there's ones that matter more than others, and we'll get into that later on in this video. I don't want to say it now because it'll just be a little bit too confusing. We're going to go one at a time, but they will all be in this video. But liquidity, with that being said, liquidity sweeps happen literally on every single time frame, every single minute, right? But we only want to focus on the ones that matter the most. Now, with that being said, just because we sweep out an area does not mean we're guaranteed a reversal every single time, right? Price could have easily, after it took out all these lows right here, price could have easily just went up like this and then continued farther down, creating a downtrend, right? So not every time we're going to get the liquidity sweep, but it is important to know where liquidity sweeps happen the most. And a good way to tell if it's a valid liquidity sweep or not is using our other confluences we already learned about in these previous videos, such as break of structure, market structure shift, inversion for value gaps, which was last video, and also CISD, right? So say we come and sweep out these areas and we have only one singular 5-minute for value gap right here, a bearish for value gap, and we run right through it. Okay, we can most likely assume we're going to do something like this and then continue higher for the rest of the day, right? So it's better to try and react off of a liquidity sweep rather than predict it, right? So we don't want to see price come all the way down here and then just enter because we took out this low and we're essentially predicting a reversal. No, we want to wait for confirmation that the reversal is going to happen, such as, again, the inverse, the market structure shift, break of structure, or the CISD. And we want to get confirmation. Once we get the confirmation, then we can assume, okay, price is going to reverse for the day. Then you can find your entry model and enter and catch the distribution for that day. So with that being said, now that we understand what liquidity sweeps are and what their basic function is in the market for them, how do we identify good quality / high potential draws on liquidity? Well, what have I been saying since about day 3 when we started learning about candlesticks? Higher time frame holds higher power, right? So if we get a 1-minute liquidity sweep, why would we anticipate a reversal off that, right? The 1 minute is literally the lowest time frame we go besides like the 30-second, 15-second. But those don't fucking matter, right? The lowest time frame, in my opinion, would be the 1 minute. So why would we worry about the 1-minute liquidity sweep, right? If higher time frame holds higher power. So how do we identify good quality / high potential setups if it's happening all the time? Well, there's 4 main points and they're right under this box right here. So without further ado, let's get into it. What is the first one? Well, the first one is going to be session highs and session lows. So we have 3 different sessions, right? We have Asia session, we have the British session, which is London session, my British, and then we have New York AM. Those are the 3 main ones. There's also lunch, there's also New York PM, but I only trade from market open at 9:30 a.m. to about 11:15 every day. So I'm not worried about PM or lunch hour for New York. I'm only worried about New York AM along with London and Asian because those happened before New York AM, right? And we'll go into each of these 4 things. We'll go into depth later on in the video. I just want you guys to understand what draws on liquidity you can anticipate the most, right? So number 1 is going to be session highs / session lows. What is number 2 going to be? Number 2 is going to be equal highs and lows / relatively equal highs and lows. And we'll get into that in a second. All essentially that is there's 2 sets of resting orders in a relatively equal spot, which means price wants to seek out those, you know, either stopping people out or filling those orders in that general area and then reverse price, right? Next one is going to be LRL or low resistance liquidity. Now we'll get in, I'll show examples of what low resistance liquidity is in the rest of this video. That is going to be number 3, and number 4 is going to be high time frame draws on liquidity, such as previous day high, previous day low, 4-hour highs and lows, and sometimes hourly highs and lows, right? But mostly 4-hour and especially previous day highs and lows. All right, everybody, I just took a lunch break, but let's jump right back into it, right? So starting off with sessions, we have 3 main sessions. And if we're trading New York AM, all we're really worried about is just London and Asian session, right? Where's the highs and where's the lows of those 2 sessions? Now, right as New York AM opens at 9:30, this is the best time to look for liquidity sweeps because this is where the most manipulation happens, right? So say we have London lows and Asian lows right below us and we're in a bullish market. Wouldn't it make sense for the market makers to manipulate the market lower, stop out all the retail traders from the AM session, along with filling the Asian and London previous session lows so we can continue price to go in the higher direction? New market makers are coming in literally every single session. So when AM opens up, now I'm using AM as an example because that's what I trade. So when AM opens up, they want to seek the high time frame draws, in this case, Asian and London lows, fill those orders so they have enough capital to reverse the market and push where they want to go. Now, I made a little drawing down here, and it can go both ways, right? So say all this chop sesh over here happened before, and this line is 930, and this is where we're opening up New York AM, right? We have Asian highs above us, London highs above us, but we also have London lows below us and Asian lows below us. And there's also equal lows right here as well, okay? So with that being said, what kind of market are we in right now? Are we in a bearish or bullish market? We're in a bullish market. Why? Because we keep creating higher highs and higher lows, okay? So with that being said, if we want to continue price higher, what is the most ideal situation to happen at market open? Well, market opens, we come down, take out the equal lows, take out the London lows, take out the Asian lows. So then we can go up and now target the London highs and Asian highs. Now, with that being said, say we find an entry right down here. Say we get an entry right here, and we want to long the market with the big banks. Our stops to go below these lows. Now, what can we target as our take profit areas? Well, what do we like to seek out? We like to seek out high time frame draws on liquidity. So what high time frame draws on liquidity do we have on the buy side? Yeah, you fucking bet. We have the London highs and we have the Asian highs. So not only can we use this for areas of reversal, but we can also use these as our take profit areas. Now, with that being said, I have a general bias going into the morning, but I'm never married to it, right? Because price can easily do something like this. We open up and maybe we manipulate higher, right? So when the New York AM market makers come in, they want to short the market. Well, they have no problem shorting the market. Why? Because we just stopped out all these traders right here and filled these London high and Asian highs. And again, same thing, we can target the lows of each session as take profit areas. So moving on to actually show what it looks like on the charts, right? So right here, we have 930 market open. What do? Well, we manipulate lower. What do we get? We have London lows right here. Asian lows already got taken out by London. And what did it do? Asian lows got taken out. We reversed up. Now, what do we do in New York AM session? Well, we open, manipulate lower, sweep out London lows, and go higher on the day. Same thing in this example. Pre-market, we took out London and Asian lows. What do? We took them out, manipulated higher. Then, what do we do at market open for the 930? We took out London highs, and what did price do? Price shit the bed and reversed. And again, we have an accumulation zone. We manipulate lower during pre-market, taking out London lows, taking out Asian lows. And right as market open, right after we took out the Asian lows, what do? Flip to the upside, reverse price, and then we can target London highs as our take profit area. Now Drake slapped his meat on my screen, and we ended up going all the way the fuck up. Actually, in this specific trade, I was looking for a retrace and then target internal highs up here, but we never got that. We ended up just going all the way up. And finally, for our last example, what do we have here, right? We swept out London lows pre-market, but we didn't react off it. Why? Well, what did the market want to do? We wanted to come down, take out Asian lows, and what did we also get with the Asian lows? Well, we got an Asian low SMT. As you can see here, ES did not sweep out the Asian lows, but NASDAQ did, which means ES does not have to. And then from there, what do we get? A fucking bull run to the upside. Okay, so now that we understand session highs and lows, let's now move on to equal highs and relatively equal highs. So what is equal highs and relatively equal highs? Well, it's two sets of resting orders in a specific spot that is near each other. So what does that look like? Say we're in an uptrend, right? Create highs right there, and then another one right here. Trending down. Now what? Okay, well, we have equal highs right here, and I'll mark that in red. Equal high. And where is our relatively equal highs at? Oh, we have one right here. Now, why is this a relatively equal high? because it's not equal, but it's relatively equal, right? It literally says it in the name. So these would be equal because they're matched up perfectly, and this would be relatively equal because it's right next to it. So these are strong draws on liquidity. Why? Because we have 1, 2, 3, and I guess you can incorporate this as well. This would just be another high, right? Buy side liquidity. So you have the relatively equal highs, you have equal highs, and you have buy side liquidity all resting right here. So say we just came down and swept out oh my god. Oh my god, what the fuck? Cool. So we came down and just swept out Asian lows. And what do we want to do? We want to reverse price, right? So when we reverse price, what can we look for? We'll look for an inversion somewhere in here. We can look for a CISD. We can look for a break of structure, right? Whatnot. Now, what is price going to seek out? Price is going to seek out these general areas of liquidity, right? We have buy side liquidity, we have relatively equal highs, and we have equal highs right here. Now you might be saying, well, why don't we just take out buy side liquidity and reverse? Well, it doesn't make sense if the market just takes out one of these when there's 3 or 4 different sets of resting orders in that general area, right? It would make the most sense to fill all those orders before then reversing back down and doing something like this. Equal highs and relatively equal highs are a very easy concept to understand, right? Why are they a high draw on liquidity? Well, because there's 2 different sets of resting orders in that general area, so it would make the most sense for price to push up, sweep all those, all that whole general area out, right? Fill all those orders and then reverse price back down. Okay, so starting off with our first example, we are here on the S&P 500, right? So what do we have? Well, we have equal lows right here. What is that? 2 sets of resting orders where there is stop losses, limit orders, take profits, that general area, right? What do we have below it? Well, we have another low in that general area. This is a relatively equal low to these 2 equal lows. And then there's also this low, which is also a relatively equal low. So what do we get? Well, what does price do? Price seeks out, fills all of these orders in this general area, and then what does it do? It reverses to the upside. So exhibit number 2, what do we have here? We have equal lows. Then what do we do? Price leaves the equal lows, coming up, actually creating equal highs again. Price retraces down into this fair value gap. We come back up, take out the equal highs right here, right? From there, right after we take out the equal highs, price reverses directly to where? This equal low area. Where do we get the sweep of liquidity? Right here. Equal lows are now filled. Price retraces back up into this fair value gap, shits the bed one more time into where? To this general spot where we have 2 candles in the exact same area, where if we scale down, I guarantee you, oh my god, where is it? This shit is deep as fuck, huh? Boy, this shit deep as hell. Jesus Christ. Where we also left equal lows, right? Bottom of this wick, also a low right here, same spot, 2 sets of resting orders in those general areas. What do we get? Oh my god, where is this shit? How far over was it? Jesus Christ. We get a sweep of that, and what do? We reverse back to the upside. Moving on over to ass crack, right? What do we have? We have a high right here. We have a high right here. We have the top of the wick right here, which is also liquidity on the lower time frames. We also have a high right here. What is all this? This is all relatively equal highs. Well, where's price? Price is right here. What does the next candle do? Next candle pushes up. What are we seeking? We're seeking these relatively equal highs. Sweep out all those highs and holy Drake to the downside, right? Absolute rumble mania to the fucking downside. And it just kept on going. Taking out, what did it go take out? Took out these lows. Took out these lows right there, relatively equal lows. Took out these lows, also relative in the equal or in that general area. What did I take out? Took out these lows. Oh my god, need I say more? Need I say more? Took out that set of lows. Took out this set of lows, right? So we just shit the bed and filled all this trend line liquidity right here, which is actually low resistance liquidity, and we will get into that literally right now. Now, jumping into our final topic, we are going to be talking about LRL, or low resistance liquidity, right? So low resistance liquidity is very similar to relatively equal highs and lows. However, this is the only difference, right? So we create a trend line liquidity. What do we have? We have a high right here. Well, what do we have? We have a high right here. What do we have? We have a high right here. Okay, so on and so forth. You guys get the gist. What do? We create this trend line liquidity. Then what? We come up very quickly, sweep all of that shit out, or most of it, and then continue to dump in the trend, right? It's essentially a continuation liquidity sweep, right? So this is our bearish example, and here is our bullish example, right? Trending up, right? Creating higher highs, higher lows. What do we have? All these lows are unswept, creating trend line liquidity. What do we get? We get a manipulation leg down, sweeping out most of it, if not all of it. And then what do? We continue higher. Now, I'm actually really glad we're talking about this because there was a few examples today of this, which is perfect, right? So what do we have here, right? We have an uptrend, but it's not a clean uptrend, right? We're just higher highs, higher lows, higher highs, higher lows, higher highs, higher lows. And most of these lows are unswept. So what do we get? Well, we get a manipulation leg down, sweeping out most of these lows, right? It doesn't have to be all of them, just has to be most of them. We just have to fill most of the orders so we can continue higher. Then what do we get? Continue higher to the upside. What happens right after that? We continue creating LRL all right here. What do we get? Well, get a manipulation leg down, sweeping out most of the lows, right? Not all of them. All of them would be at this leg right here, but most of them. And what do? We continue higher. Same thing right here that happened previous in the same day. What do we have? We have LRL, low resistance liquidity, right? Trend line liquidity on the way up. What do we get? We get a manipulation leg down, sweeping out most of it, and then we continue higher for the day. Now, moving on to the 5 minute in this example right here, right? We're in a downtrend. What do we have? We have LRL all right here. Most of these are unswept. What do we get? As we're trending higher, also creating LRL on the sell side, what do we get? We come up, take out this LRL, then what do? We immediately flip and take out all of this right here. This is just the way the market moves. Low resistance liquidity is happening all the time. Now, I especially look for this right as I'm about to enter, right? Right before I enter, I want to see either the LRL get swept out or I can use the LRL as a take profit area. This is why liquidity sweeps are so important because they draw price to those general areas, but you also have to watch out for reversals, right? Reversals can be good and bad, right? So that's why you also set your take profit at these areas because if price decides to reverse, well then who cares, right? You're already out of the trade. So that being said, that will be all for today's video. For your guys' homework tonight, I want you guys to spot 20 examples of liquidity sweeps, right? Very easy. I can spot 10 right now. Here's a low right here. What do? Get swept out, goes up, all right? Opposite way. What do we have here? We have a high right here. What do? Sweep out, Rumble Mania to the fucking downside. What do we have over here? We have lows right here. Relatively equal low right here. What do we get? Sweep work. Drake to the upside. All right, so this is very simple. I want you guys to go on the charts again, spot 20 examples of liquidity sweeps. And from there, we'll be back tomorrow with another video. Tomorrow, we're going to get into SMTs, which also incorporates liquidity sweeps. That's why I wanted this video first and the SMTs next. So again, with that being said, that'll be all for today. You guys enjoy the rest of your night, and I will see y'all boys tomorrow.